Is interpreting income statement difficult? If your answer is yes, then you should definitely watch this video. Hi, I'm Sowjanya and I coach business owners as well as corporate executives to understand finance in the most practical way. In order to understand the structure of the profit and loss account or the income statement, it's very important for us to understand the key elements there.
In one of my one-to-one coaching session, one of the corporate executives with whom I was having one-to-one conversation was asking me this question. Why is that we don't see the trading account and the profit and loss account in the annual reports and the income statement published by them? Trust me, every student has this question.
The first most important structure of the income statement is the topmost line. Why do I say topmost line? Because the first and the foremost mention there is sales. Sales are known as the top line. Yes, top line is a very popular jargon which is used in the corporate world, and top line means nothing but sales. These sales are largely from revenue from operations and other income. After we understand this most important terminology called top line, which is used quite often in interpretations analysis, the next most important jargon, as popular as this, would be bottom line. Bottom lines are nothing but profits. Profits are the ones which are derived after expenses are deducted from the sales. So sales minus expenses are profits, and profits are bottom lines. And these bottom lines are known so because it's the most last ending line, the bottommost line. So this is another important popular jargon. So next time when you hear top line and bottom line, you would definitely know what it is. When we try and discuss top line and bottom line, in the middle are these expenses. Means sales minus expenses are profits. Profits are bottom line. When we talk about expenses, there are two categories of expenses which are presented in the income statement or the profit and loss account. One which is accrued or incurred, and the other which is paid. So for a corporate firm of an organization, they don't have a choice but to show their performance in accrual basis. We do have separate videos which are lined up in coming days, weeks, which will help you to understand all of these terminologies, especially accrual, better. In fact, our next video is going to be on the segments of the expenses. Please do watch that and help to upskill yourself on these terms as well. Coming back to our current discussion, when we speak about sales minus expenses as bottom line, after this is the appropriations, which becomes relevant as a part of the discussions. Appropriations are nothing but utilizations of profits or distributions of profits. What is very important to note is the difference between dividends and expenses. Dividends are not expenses but appropriation of profits. So be very careful when you are expressing dividends. It's not an expenditure. Never ever say dividends are expenses. Dividends are always appropriations. So be careful with the differentiation and your expressions of appropriations and charge against profits, which are nothing but expenses. So what is retained after these appropriations from the bottom line would be retained earnings. As the name suggests, these are the earnings which are retained by the entity after the appropriations. So these retained earnings are nothing but bottom line minus appropriations, and they are presented along with the capital of the entity. So capital plus the retained earnings would help us to understand a terminology called as equity shareholders funds. Equity shareholders funds are also called as net worth or also called as just equity, and they are presented on the liability side. Once we understand these retained earnings and how we are presented in the balance sheet as well, we also need to take our attention to next most important acronym or a short form which is used with respect to income statement. Now before I go to that, income statement is always expressed for a particular period of time, for the year ended, for the period ending, for the quarter ending, for a month ending. Such an income statement helps us to understand the performance of the entity, the total revenues by the total expenses, which will help us to understand profits. But can we understand profits in a different way, analyze and interpret in a different way? Yes, and that is possible through EBIT. EBIT stands for earnings before interest and taxes. Can we understand the earnings or the performance of the entity before we pay tax and before we pay interest? Because tax and interest are not operating expenses. We don't have to spend or pay tax for the purpose of running the business. we pay tax on the profits earned. In a sense, EBIT would be arrived adding back the interest and the tax component to the bottom line. Hence, it's also expressed as an operating profit. So this will help us to understand the bottom line in an appropriate manner only from operations, what is the performance of the entity. When we talk about EBIT, another acronym which is much more similar in terms of reference but has a differentiation of interpretation is Ebitda. Ebitda is nothing but EBIT plus the depreciation or the amortizations. Depreciation and amortization are non-cash expenditure where it's just a charge to the profits for the quantum of the expenses which are incurred because of utilization of assets. So it's the utilization of assets over the useful life of the asset which is quantified in numbers and called as depreciation. So depreciation does not have a cash outflow. Such a depreciation or an amortization in the case of an intangible asset is added back to EBIT, which will help us to understand Ebitda. Ebitda and EBIT are popular jargons when forecasting is done, when analysis is done, when interpretation is done. We would want to understand the performance of an entity of the current year vis-a-vis last year, or understand the performance of the entity in the current year vis-a-vis the competitor, or understand the performance of the current year vis-a-vis the segment or the industry where the entity operates. So to do all of these things, I hope our explanation of understanding income statement today has helped you. To take a quick recap, income statement is understood to contain revenues minus expenses is equal to profits. Revenues are nothing but they're called as top line and profits are nothing but called as bottom line. From the profits, we have appropriations which will help us to arrive at retained earnings. These retained earnings are presented in the balance sheet along with the shareholders' capital. Together with shareholders' capital, these retained earnings are called as net worth or equity shareholders' funds. We also understood EBIT, which is nothing but earnings before interest and tax. Such an earnings before interest and tax, if it is also having an addition of depreciation and amortization, it's called as Ebitda. I hope you've liked this information. If you want to understand more of such kind of easy interpretations of various topics in finance, do visit us in this page on every Wednesdays and Fridays. And if you want to understand more of such kind of content and ask questions, you can join our community. Our next video is going to be on segments of expenses. Do watch for that video and do like and comment and share this video with people who can benefit. And we would definitely want to understand if you've liked our representation of the content in the mind map. We would be waiting to see your comments. Thank you.